Today, I quickly want to review some slides covering the topics we're going to be going over in our in-person seminar on April 27th, the title of which is Bank Failures, Recessions, and Interest Rates, Oh My. Around this time last year, we were going over the geopolitics of Russia invading Ukraine and the potential implications for the market because of that. Today, it's going to be a little bit different. We've had a lot of things change since then. So we're going to start off by breaking this into a few different videos. This is not going to be a verbatim rundown of the presentation we're doing in our office, but essentially the goal is to quickly go over the slides, the material, and allow you to see what we were talking about. And if you have any questions at all, feel free to let us know. We'll go over all this stuff in more detail. So that being said, we're going to break this into 3 videos. The first, this video, is going to go over a year-to-date review. What's happened in the first 3/4 months of this year. Then we're going to put today's events, bank failures, etc., in historical context. And then the final video is just going to go over the psychology of investing in markets like we have today. So that being said, the year-to-date review. Right here, what we're looking at is that the stock market in the first part of the year has actually done pretty well. I'm obviously recording this before the seminar, so we're about halfway through the month. And so through 4/17, we've seen positive returns in the stock market. But it's important to look at the fact that there's been a big discrepancy between the different indices. So this is not a case where all stocks have gone up equal amounts. The Dow Jones Industrial Average is up roughly 2%. The S&P is up 7.5%. Small cap is basically flat on the year. And the NASDAQ Composite is up 15.5%. So an investor's experience with the stock market this year has been highly dependent on what they're invested in. This side over here is looking at commodities. And again, this is only looking at through the first quarter. But if you recall last year, when Russia invaded Ukraine, oil and gas prices went way up. They went through the roof. And I had a lot of clients telling me that we needed to load up on oil and gas stocks because oil and gas, or I should say, oil was going to go up to $200 a barrel. Gasoline was going to go up to $5, $6 a barrel. And all these other things were going to happen that were going to make commodities go up in perpetuity. Obviously, those things didn't happen. Cycles tend to, or I should say, commodity prices tend to revert back to a mean. And that's what we've seen this year. And that the average commodity index is down about 7% through the first quarter of the year, with energy being down about 11.9%. The biggest loser so far on a year-to-date basis, again, only through the first quarter, was natural gas. There were a few winners here, but again, when we're looking at the commodity market as a whole, commodity prices have come down as inflation has come down. So this is something to keep in mind when we're looking at the markets as a whole, and something to keep in mind in generally looking at investing in the things that did best last year. They tend to go the other way in the next years. Volatility. This one's interesting because with all the things going on in the world, SVB going down, fears of recession, you name it, we've actually seen very, very little volatility this year. And so, again, right now we've had 2 days on a year-to-date basis through the first quarter where the stock market was up or down more than 2%. In previous years, we saw much bigger swings more frequently. So it's very likely, just from a historical basis, that we do continue to see more volatility as the year moves on. But in the first part of this year, we simply did not see that. Year-to-date changes in interest rate. This is a big one. So this red line shows where we are today from our interest rates, and this blue line shows where we were at the start of this year. And what we see is at the start of the year, the short-term rates were slightly lower, but the longer-term rates were slightly higher. And so what's happened is as the Feds raised rates, these short rates, again, the bottom of this chart shows this is 1 month, 1 year, 30 year, and this is our interest rate on the side. It is showing us that short rates have continued to go up as the Fed has raised rates. But beyond 1 year, rates have come down very, very significantly as a result of just general Fed interest rate policy and what we're seeing in the market. The consensus now is that the Fed is going to be able to lower rates more quickly given the economy and where we are today. So we've seen interest rates come down very, very significantly. In fact, when I go over the next slide, we're going to see that interest rates have actually had one of the largest drops in history. In fact, this chart is looking at the 10 largest 1-month drops in short-term interest rates, specifically looking at the 2-year. And what we see is that March of 2023 was in the top 5 for largest drops in the 2-year, but it's also the only one where we did not have any stock market volatility as a result. So again, somewhat of a strange year, but again, interest rates have come down, which is why we're seeing this chart, which shows that there's this gap between where we started and where we were, and that benefits. That's why you've seen the value of your bonds go up. Which brings us to this chart, which is showing that money market funds in the beginning of this year have taken in a huge amount of money, certainly more so than any other fixed income asset class. So when we're looking at the money market and bond flows from basically December of last year through the end of February, we saw that money market funds took in $165 billion in new assets, which basically dwarfs any of the other areas of the bond market. Now, as we talked about in some other seminars, there's a reason that we are not loading up on just money market funds despite short rates being good, and that is when interest rates come down in the long end, you do not see any appreciation because the shorter your duration, the less your price changes. So that's what we're looking at here on the right side, is that it's saying that year-to-date performance through the first quarter of this year, money market funds are up 1%. Now that's kind of what I would expect to see. If a bond is paying 4% on the year, we'd expect to see 1% in quarter 1, 1% quarter 2, 1% quarter 3, 1% quarter 4, if price is not an object. And so that's why we're seeing money market funds have generated 1%. But what you see is that intermediate core, the longer the bond, the better it's done, because as interest rates come down, as we saw in this chart over here, prices on those bonds go up. So again, if you have a 10-year bond that's paying 4%, and let's say it's giving you $40 a year come hell or high water, and now interest rates go down to 3%, so the new ones pay $30 a year, someone's going to give you, let's call it $1,100 for your bond, because at the end of the day, yours pays 40, theirs pays 30, and it all evens out at the end. So again, when we're looking at the bond market as a whole, we've seen that keeping a longer duration of the portfolio has generally benefited us in the first part of the year. So that's where we are year-to-date basis. Again, that is a quick video to go over some of the things that we're going to go over in the seminar. The next video is just going to talk about putting today's events of bank failures and things like that in historical context. If you have any question about this or anything else, just let us know.